Hello, finance experts. My name is Sandra Barrios, and this is my Finance 551 project. I looked at 10 different companies in 2 different industries over a 5-year time span. These 2 industries were biotechnology and restaurants. The individual analysis as well as my final company choices are based on data averaged over the 5-year period. I'm going to start with the biotechnology industry. The biotech industry consists of companies engaged in the research and development of new drugs, medical devices, and procedures. This industry includes the manufacturing and marketing of drugs as a result of direct research and development. Biotech companies are almost always unprofitable, and many have no real revenue at all. Biotechnology is also characterized by long development lead times. It can take as much as a decade to get a new drug from test tube to pharmacy shelf. What's more, there's an overwhelming likelihood of failure, as 85 to 95% of all prospective new drugs fail to reach approval. Still, for those that succeed, the rewards can be tremendous. It's an inside joke that the difference between biotech and pharmaceuticals is profitability, and this distinction is what differentiates this industry from the pharmaceutical industry, which is primarily concerned with the marketing and sales of pharmaceuticals that other companies have researched and developed. Now, the 5 companies that I analyzed were AbbVie Incorporated, Celgene Corporation, Immunogen Inc., Regeneron Pharmaceuticals Inc., and United Therapeutics Corporation. For short-term solvency, Immunogen is easily best structured to meet their short-term obligations, placing first in all 3 solvency metrics of current, quick, and cash ratios, with AbbVie trailing the other 4 in their ability to meet their short-term obligations. Keep in mind the healthy short-term solvency ratios of Immunogen as we proceed further into the financial analysis. For long-term solvency and long-term debt, we are just going to throw out Immunogen as being unable to even fairly compare them to the other 4. Of those, United is using the least debt to finance its assets, as well as having the best ability to cover all short-term debt and still have cash remaining. However, United's high cash coverage ratio could also indicate that the company is inefficient in the utilization of cash or not maximizing the potential benefit of low-cost loans. It may also suggest that United is worried about future profitability and is accumulating a protective capital cushion. Looking at sales to total asset ratio, Regeneron is 11% more efficient than their nearest competitor, United, and a whopping 154% more efficient than Immunogen. Moving on to profitability, United is the clear front runner overall. They have the highest profit margin percentage of the 5, as well as the highest return on assets and 3rd in return on equity. AbbVie presents the highest return on equity of the 5, which is not surprising, because if you remember, AbbVie had by far the highest equity multiplier of the group every year for the last 5 years, which resulted in a corresponding increase in their return on equity. Regeneron takes the top spot in both price to earnings and enterprise value. Keep in mind that it is difficult to use PE ratios to compare different companies with different amounts of leverage, and we've seen that these companies definitely have that. AbbVie takes first place here in the market-to-book ratio. And fun fact, in basic terms, if the market-to-book ratio is above 1, then the stock is undervalued. If it's less than 1, the stock is overvalued. However, biotech companies tend to have higher market-to-book ratios due to intangible assets, such as intellectual property like patents and R&D. This high market-to-book ratio reflects shareholder expectations on the future value of a firm's R&D expenditures. I've already mentioned Regeneron being first here, as well as having the highest PE ratio. The enterprise value to EBITDA is a better measure than PE because it's capital structure neutral, it controls for different levels of capital expenditures, and it's a better measure of a company's takeover value. Typically, EV to EBITDA values below 10 are seen as healthy, but comparison of relative values among firms operating in the same industry is a good way for investors to determine companies with the healthiest EV to EBITDA within a specific sector. United presents the highest economic value added spread, as well as the lowest price to free cash flow ratio spread of the group, placing them in the top spots for these market values. Bloomberg was really stingy with supply chain information, so I can only work with the info that I was given. AbbVie lists 13 suppliers but no customers. Celgene lists 10 suppliers and 4 customers. Immunogen lists no suppliers but 6 customers. Regeneron lists 3 suppliers and 6 customers. And United lists 0 customers and 0 suppliers. So, working with only the info that I have, Celgene, with 10 suppliers and 4 customers, would be the overall most diversified company in terms of supply chain, but this entire analysis really doesn't tell us much. My pick for the best company, of the 5 companies profiled, my choice for the overall best biotech company is United Therapeutics Corporation. United's operational performance is the most consistent of the group over the 5-year period. Of the group, we see that while both AbbVie and Celgene have higher ROEs, they're also carrying higher levels of debt for lower profits. Their asset turnover is also lower. Regeneron and United have similar ROEs, similar and much lower levels of debt, higher profits, and better asset utilization. As an amateur investor, I see both these companies as equal candidates, so I turn to the NASDAQ experts who have United Therapeutics just edging out Regeneron as a very positive, strong buy. When compared to the other 3 companies in the group, we're excluding Immunogen in this, by the way, the DuPont analysis demonstrates United's interest and tax burdens are similar to the other successful companies in the group. Their operating margin and financial leverage is the best of the group, and their asset turnover is the second best behind Regeneron. Unfortunately, Bloomberg's supply chain information is incomplete. Now, as far as projecting stock prices into the future, United Therapeutics does not pay a dividend on stock and does not foresee doing so in the immediate future. So, without dividend information or realistic assumptions of future dividends, according to one of Dr. Cresson's stock videos, we can still use their EPS information to get a loosey-goosey estimate. United's trailing 12-month EPS was 9.31, so I would expect the stock price to increase by at least that much in 1 year. It's also worth noting that investor return on non-dividend paying stocks is in growth. Now, I promised to give you a little information on Immunogen. Don't feel too badly for them. They are doing well in the market despite bleeding money all over the place. Immunogen is a nearly 40-year-old company that had a cancer drug greenlit by the FDA in 2013 and currently has a handful of antibody drug conjugates in clinical stage development. In January 2017, the company began a late-stage trial with its most advanced proprietary candidate, an anti-cancer drug with a name that's like this long, and I'm not even going to attempt to pronounce it. However, later stages of drug development tend to be the most costly, and Immunogen's operating expenses are rising fast. With that in mind, not surprisingly, shares were selling at a high of $19.23 in 2013 when their first drug hit the market, dropped to a low of $1.78 in December of 2016, and has steadily risen to $11.59 in June of this year, in what I expect is cautious optimism that this drug will receive positive trial results in 2019 and an FDA approval to market in 2020. The 5 companies that I analyzed for the restaurant industry were Dunkin' Brands Group, Incorporated, Nathan's Famous, Inc., Papa John's International, Inc., Sonic Corporation, and Starbucks Corporation. Looking first at the short-term solvency of the 5 companies, Nathan's takes first place in the current quick and cash ratios, while Starbucks seems to have the most difficulty meeting its short-term obligations. Moving on to long-term debt, Starbucks by far outperforms the other four in terms of effective debt management, while Papa John's has the best cash coverage ratio of the group. On the downside, Dunkin' has the highest equity multiplier as well as the lowest cash coverage ratio. As one analyst put it, America runs on Dunkin' and Dunkin' runs on debt. Dunkin' has been well known in the industry as holding large amounts of debt, and in the fourth quarter of 2017, Dunkin' underwent a refinance transaction. And this is why you're going to see numbers that are really out of the ordinary here with this equity multiplier of 466.13. Nathan's has also been borrowing money to pay dividends. A dividend is an owner's share of profits, not debt. These borrowed dividends have to be paid back plus interest, and when a company starts pulling profits from the future, it can result in a lack of confidence in the company's future cash flow. Now, there may be practical reasons why a company would choose to borrow to pay dividends. Companies that pay dividends regularly communicate that their company is stable, it's growing steadily, and it's rewarding its investors for commitment to the company. So, any changes in dividend policies also communicate a message to the investors. When a company with a history of paying dividends chooses not to, the investors perceive this as a potential financial, having potential financial difficulties within the organization. So if a company is stuck between a rock and a hard place, keeping investors happy can be more of a priority than what is hopefully only a short-term debt. Papa John's has the best turnover ratio of the group, with Dunkin' once again trailing behind the others. And moving on to profitability, despite its issues with long-term solvency and asset management, Dunkin' has the highest profit margin of the group, with Papa John's having the lowest, although Papa John's has historically run on a razor-thin profit margin, so this is nothing new. Papa John's is the most efficient at using its assets to generate earnings, while Dunkin' is again at the bottom of the group. Unfortunately, Bloomberg did not provide return on equity information for the last few years for 4 of the 5 companies, making this very informative ratio useless for analysis. An interpretation of the PE ratio is to see it as a reflection of the market's optimism concerning a firm's growth prospect. The borrowing to pay dividend strategy must be working for Nathan's because they are posting the highest PE ratio, with Sonic making their first appearance on our list as having the lowest. Negative book-to-market value implies that a firm must be financially distressed since liabilities are greater than assets. To be honest, I'm not really sure what's going on here given the wild fluctuations and inflated numbers due to debt and restructuring. The only company with any consistent numbers over the last 5 years is Starbucks, so they're my pick for the best market-to-book ratio. As I mentioned earlier, typically EV to EBITDA values below 10 are seen as healthy, but comparison of relative values among firms operating in the same industry is a good way for investors to determine companies with the healthiest EV to EBITDA within a specific sector. We can see that Sonic has the lowest ratio, although 3 of the remaining 4 are all within close range. Only Starbucks at 46.95 is well over the healthy range. Papa John's presents the highest economic value added spread, with Dunkin' as the lowest. And Nathan's posts the lowest price to free cash flow, putting them in the top spot, with Starbucks as the highest. It's worth noting, though, that both of these averages are based off of only 4 years, where the other 3 are based off of 5 due to the lack of 2014 information for these companies. Dunkin', in supply chain, lists 10 suppliers and 2 customers, one of which is Baskin-Robbins, and that's their own branded segment. Nathan's lists 1 supplier and 8 customers. This extreme lack of diversification in suppliers could lead to either 1, catastrophe if something happened to the supplier that impacted Nathan's supply chain, or 2, strong arming by the dominant supplier to extract higher prices from Nathan's. The overall impact of higher supplier position can decrease the margins that Nathan can earn in the market. Papa John's lists 1 supplier and no customers. Sonic lists 2 suppliers and 1 customer. Starbucks lists 25 suppliers and 12 customers. So my pick for the best company overall is Starbucks. Of the 5 companies profiled, I'm not really sold on any of them. ROE was useless due to incomplete data. Dunkin' had the highest profit margin, Papa John's had the highest total asset turnover ratio, and Starbucks had the lowest debt. Supply chain information was underwhelming, with only Starbucks showing a diversified supplier and customer listing. So, despite what Dr. Cresson says, I am not a finance expert, so I turn to those who are. According to the analysts at NASDAQ, Starbucks just barely edges out Papa John's as a positive buy. It's worth noting that the data for this project was pulled prior to Papa John's CEO stepping down in July 2018 due to unfortunate comments made during a business meeting. It will be interesting to see how the second half of 2018 will be affected for Papa John's. When compared to the other 4 companies in the group, the DuPont analysis demonstrates Starbucks has a higher interest burden than the other 4, but also has a higher asset turnover ratio. Their tax burden was comparable to all except Dunkin', which was exceptionally high. Bloomberg returning complete information for the leverage ratios of the other 4 companies, making an accurate comparison difficult. For projected future stock price, according to Yahoo Finance, Starbucks is enjoying a growth rate of approximately 17% for the last 5 years. Assuming a slightly more conservative rate of 15%, we can use the future value equation to project a stock price of $58.55 next year and $67.33 in 2 years. I've chosen United Therapeutics Core and Starbucks Core as the 2 best in class, but comparing them against each other is like comparing apples to turtles. There's simply not much in common at all between the 2 industries. That said, if I were going to invest my money into either of the 2, my choice would be United. United has a better ability to meet its short-term obligations, it uses less debt, and it has significantly higher cash coverage ratio. Total asset turnover is lower, but profit margin is higher. Starbucks has a better ROA and ROE, price-earnings ratio, enterprise value to EBITDA, economic value added spread, price to free cash flow, and market to book. Because the companies are so different, I again turn to the NASDAQ experts, with their recommendation of United as a very strong, very positive buy, versus Starbucks simply having a strong positive buy. And I'm going to trust the experts on this one. This concludes my Finance 551 project report. Thank you.